folks, it's Dave Burrows. It is Tuesday afternoon. I want to welcome you to our weekly barometer readings webcast. I've had the opportunity to be away for a couple of weeks, so I had a lot to catch up on when I got back. I want to thank Diana and James for doing such a great job while I was away. What do you know? I came back engaged, so it was a pretty eventful couple of weeks, and I appreciate everyone's patience for not being around. Obviously, lots going on. It's nice to see markets behave well when you're away. You know, you've always got one eye on your phone or on your screen, but I tried really to shut down for a couple of weeks, and you know, you come back always with fresh perspective and a fresh opportunity to look at the charts and see what's going on. So I spent the better part of yesterday and today running through a bunch of things, and just wanted to share some thoughts, you know, as we do, coming at it sort of from the top down, to say, what is the market telling us? And our portfolio is aligned. The portfolio team was hardworking during the period. Of course, everybody's got a very clear view on the strategy and our tactics. And I'm pleased to say, you know, they really executed well while I was gone. So just off the top, you know, we continue to believe we're in a structural bull market in stocks that started in 2013. And as is generally the case, they go on a long time. It's been about 12 years since the S&P made its first new high since 2000. We've had lots of wiggles along the way. And when we look at the last two bull markets, the thing we keep in mind is that it has tended to be lower bound by a rising 200-week moving average. And in the most recent pullback, we basically pulled right back to that 200-week moving average. And the markets rallied, you know, surprisingly well through the months of April and May. And here we are, we're about 4% off the highs in the S&P. If we take a look at the daily chart, going back to the low in October 22, there's an uptrend that really remained intact all the way through this period. And of course, we kissed that level on the news of the tariffs going back to the very beginning of April. And the market has rallied back, you know, surprisingly well. I've always said it's really important to understand the market you have, not the one that you expect or the one that you want. So certainly, you know, it's always tough going through corrections, and it's our job to try and manage them. I think we did a pretty good job keeping the volatility low. And we'll see where we go from here. We are back above a 200-day moving average. We're back, the S&P is back above 50-day moving average. You know, things seem to be repairing. There's some things we're watching seasonally. You know, it's the end of May, the old sell in May and go away. It always is a thought process. There'll be some rebalancing at the end of the month after a strong month for stocks and a very weak month for bonds. But, you know, it's important to see what's happening under the surface. And so we're going to work our way through that. If we look at the NASDAQ, same thing. It's about 4% off the highs. Same sort of issues on some of the technicals. There's some divergences, but we are back above all the moving averages. And internally, while the indices say one thing, there's individual stocks say another. We're watching the equally weighted S&P. It's made a couple of lower highs, and we'll see whether we can break above one of these highs and get a shift there. And then we look at the Russell 2000, a broader universe of sort of mid-cap stocks. And it has not rallied the same way. It was about 30% off the highs on the sell-off. And we've recouped about a third of that, trading below the 200-day moving average. And again, you know, some divergences here. So, you know, I think things are smoothing themselves out. I think the fact is we are going to live with bumpy news flow. The market seems to be absorbing the news fairly well. It does appear that there is jawboning going on. When things heat up, things get a little bit more aggressive. When the market gets sloppy, there seems to be some conciliatory talk and measures. And the fact is, I think we're going to live with this. So we're going to have to work our way through this using the best tools that we have. I think one of the things that we think is important is the US dollar. And, you know, it really has been weakening all through the year. We broke some important support going back a couple of years recently. And we're sitting just right underneath that level. So the US dollar has been weakening versus every major currency. And I think that that's played a part in what we're seeing going on in other parts of the world. Assets that have been hiding in the US because that was the only place you could get a return, aren't getting the same kind of support from the currency. They're not getting the same kind of support relatively from local markets. And as a result, we're seeing money flow into other major markets. So this is the SPDW ETF. It's made up of developed world equities outside of the US. And when I think back to that first chart I start with each week, when markets go years and years and years without making a new high and eventually do make a new high, generally that means something's changed. Generally, it means something that's going to be sustainable. It doesn't mean it's going to go in a straight line, but it does mean that you have to recognize something's changing in the world. So whether we're looking at the Euro Stoxx 50, which broke out back in the early part of 2024, and despite the news flow and despite a very weak month in April, closed at the high for the month and has had a very strong month so far in the month of May. So we're now 4 or 5 days away from the end of the month. It looks as though this is likely to hold. That's significant. European stocks behaving really well. Germany, one of the big drivers, but Italy is performing well. Spain's performing well. Part of it because financials have been leadership for a long time. And there are a lot of financials that are a lot less expensive than US stocks. But it also has to do with the currencies. When we look at Latin America, we see strength. Argentina, after consolidating for 4 months, again, last month, a big tail down early in the month, closing close to the high for the month, and a very strong month in the month of May. These look different fundamentally than the US markets, because while US markets are getting close to recouping what they gave up, global markets, are powering through to new highs. And I think that that's relevant and an important indicator for all of us as investors, because these companies are less expensive. The sector makeups are friendly based on the current environment. And the flows that came to the US took years to build up. And even a small unwind can mean things continue to change. Going to Japan, after many months of consolidating, Japan has broken out this month. And under the surface, forget the large cap stocks, the smaller cap companies, the JOF ETF, smaller companies in Japan. We talked about the fact that the Topics Index, which is 1,500 companies, has really been performing the largest of large caps. And that's why in our global fund, we focused on not the largest of large caps, but using a quantitative method to focus on building a portfolio of high relative strength stocks across global markets that meet some fundamental tests. And it's enabled us to get sort of a high grade list of securities to focus on 80 companies in the portfolio. Now, along with global stocks, the Canadian stock market broke out this month. So the S&P TSX Composite, after 5 months of consolidation and one big down month in April, blasted off this month. So things are changing. When I look across the globe, and as you know, we look at breadth. We like to see over time more and more stocks participating. Breadth across global markets is broadly green. Now, if you take all of the markets globally and put them on a distribution curve, and this is a representative group, you can see that some of the global markets have a higher percentage of stocks in uptrends than the US market does. But this is a change. So look, markets go through shifts, they go through catalysts, and then you have to see how they react to the news. And I will admit, I am surprised with how well markets have responded to some of the geopolitical changes and some of the changes coming from the Trump administration. But as we've talked about, this is a change that's been coming for some time. This is the relative return chart of the Canadian stock market, which after many years of underperformance bottomed in 2021. And on a relative basis for months and months has now been outperforming the equally weighted S&P. So there's near-term news and there's longer-term catalysts. And the longer-term catalysts build over a series of years until ultimately something breaks it out. And I think this is relevant and likely to continue. When we look at the MSCI All World Index, ex-US, versus the equally weighted S&P, same thing. You see underperformance from 2009 through 2022, going back and retesting the lows in 24. But look, the last 5 months, 1, 2, 3, 4, 5, relative outperformance. So then we're using that to inform us to make sure that we've got good global weightings across our portfolios. We started with a 5% weight in ex-North American stocks a year ago, or I guess 18 months ago. Now it would be closer to 10 plus the global securities that we hold in our standard portfolios. So this is a change I think that's going to go on for a while. And frankly, we see it in the Canadian market. Canadian dollars improving, Canadian stock market is improving. These are non-dollar assets. The other non-dollar asset is Bitcoin. And I just highlight that Bitcoin, here it is, making new highs, and it's been a stair-step process over a series of years. The truth is that the US administration is making it clear, in the absence of their ability to cut spending, they're going to try and grow their way out of this debt problem. And that's relevant. When they say they're going to try and grow their way out, it generally means they're going to try and inflate their way out. So as investors, we need assets that can protect us against having our money, inflated away. When we look at fixed income markets, it tells the same story. A generational low in rates in 2020, and these move in long waves, has moved rates sharply higher. If we look from 1981 through 2020, we clearly were in a disinflationary world. And despite all of the discussion of cutting spending and, trying to reduce the deficits, the bond market's telling us something. These are 30-year yields. Now, it's not just a US problem. There is government debt around the world, not the least of which is in Japan. And you can see, if you look at 30-year government yields over the last 30 days, they've moved higher everywhere in the world. Bond investors are saying, if I'm going to tie my money up in fixed income, what's the money going to be worth that you're going to pay me back in? And so bond investors are saying, if I'm going to tie my money up for 10 years, or even yet 30 years, I'm going to need more compensation. And that's an issue. It's an issue for companies that borrow money. It's saying that maybe the cost of money is going to continue to go up. It's saying something about the risk of inflation. And it says something about the types of assets that we want to own. So when we look at what has traditionally been a safe haven asset, a US Treasury bond, really has been falling in price now for just about 5 years. So choices, right? This is the US commodities index. So just at the time when bonds started to underperform, commodities started to outperform, and they continue to outperform. We talked about gold. Gold is another asset that protects us against the devaluation of currency or purchasing power. And even though we've talked about the fact that it can correct, and it's interesting, when you look at these candle charts, when you get a month where the price opens and closes at the same level, it speaks to indecision. It speaks to a market that's in some equilibrium that might be preparing to correct. So we think that the uptrend can go on a long time, but as we see in a bull market, you can get extended above the moving averages and go sideways for a few months. And it may well be that we see that here, but the net story is we're still in the early stages of a bull market. Now, in the short run, we have to think longer term and shorter term. In the short run, seasonally, over the months of June and July and August, gold is often flat to down. We'll see. Maybe this year is different. But we are at a point where things can pause, and that's why we reduced our exposure about 6 weeks ago. Now, this is the chart of the gold versus QQQ, so leadership in tech. leadership in tech versus leadership in gold. And we did see a change in the relative relationship of gold versus technology over the last couple of years. But again, it looks like we may be starting to correct a little. This is gold versus semiconductors, a very strong message. Again, looks like we may be correcting a little bit relative to semiconductors. Staying on the topic of commodity prices, we did have a pretty sharp move down in the month of April in copper. And for those that thought maybe we might go into recession because of these tariffs, I think it's interesting that copper has been as resilient as it has been. And again, it had a long period of consolidation. So we don't have a lot of exposure here, but it's something that we're watching with interest if it were able to get going. Again, this would be an asset that you might want to own in a world where US dollar was weakening or where there was risk of inflation. So on a relative basis, commodities relative to bonds, we'd prefer to own commodities, a hedge against inflation versus a hedge against disinflation. Stocks versus bonds, we'd prefer to own stocks. Again, relative outperformance that has had a number of pullbacks along the way, but continues to look strong on a relative basis. And frankly, we have to look carefully at commodities versus the equally weighted S&P, because it looks like there's a shift going on here as well, but you got to wait and see it break out to know. At the end of the day, we don't have to be everywhere. Our job is to find leadership, things that are relevant in the market that we're living in. We use signals from the market to help us understand, what are the factors driving things. We're always watching for change. And in the event that everything gets upset, we've got to be prepared to play defense, right? So it's about being tactical. We try to use our top-down tools, top-down meaning understanding the macro investing environment we're operating in, to choose from all the different types of securities that we could own to focus on things that have a tailwind. And when I say a tailwind, generally in a healthy market, we see over time more and more securities perform well. Late in a decline, the strongest ones turn higher first. And as things get better, more and more securities participate. It's one of the reasons we talked about when we went through this sell-off recently, building our farm team. See what is it that was holding up better than the market, so that when things start to improve from a breadth perspective, we've got targets that we can acquire, right? Finding securities that are holding up better than the market, and finding securities that are holding up better than the market and have fundamentals that would say they are better than the average company. In fact, one of the best companies, things that are good getting better. So we can find areas of the market that are seeing net inflows and find securities from our investable universe that meet our business tests. Well, that's where our portfolio should live. And then maybe we just go higher from here, or maybe there's more trouble to come. We've got to watch. So at the sector level and at the market level, we've got to watch for signs that there's deterioration in breadth, right? What is it that's seeing selling? And be prepared to do something about it. When we see that deterioration, it'll be time to raise a bit more cash and tighten up our stops and stop putting on positions and build the farm team again. But as it stands right now, and I think probably Diana went through this last week, we've seen some solid improvement in breadth in Canada, solid improvement in the US, solid improvement globally. Some of the short-term indicators are mixed, so it's not a perfect market. And we're watching for seasonality. But when it comes to the leadership themes, I think things are going pretty well. So let's start with what has been leadership for the last couple of years. Financials broke out of a bear market that went on from 2007 through 2021. These are monthly bars. This is the month of April, came down sharply, closed about at the high for the month, and has continued on stronger today and this month, and we're coming up on highs. The big banks have been leading for a couple of years. Of course, JP Morgan has been a significant leader and one that held up better than the rest during the decline. It's one of the reasons we built more of a position recently in JP Morgan. The European financials have been dynamite. This is the EUFN European Financials ETF. Look at the relative strength line going back to the beginning of this year, better than 92% of companies in the S&P, the whole sector. Santander is one of the companies that we added earlier this year. It's displaced UBS as the largest global bank outside of the US, up 1.77% today, making a new all-time high and a new relative strength high. Companies that hold up better through a decline and turn up earlier generally lead. And we saw good relative strength improvement and good relative strength through the sell-off. So the EUFN is acting well, but we're just 4 months from having broken out of a 10-year bear market. So we think this is early days. And I think that it's important to see that relative strength through the decline and relative strength as soon as money started getting put back to work. Going back to the US, the broker dealers really, have continued to power their way higher in relative strength versus the rest of the market. And Morgan Stanley is a new position that we put on through this pullback. So it's about finding strength. Companies that are strong fundamentally, companies that are beating estimates, companies that are performing better than you would expect. Moving on, Fairfax, largest position in the firm, continues to get bigger. Relative strength is making new highs today, up 3.5%. Good to see a stock hold up better in a decline and much better on the up days. The Fairfax just continues to perform well. The exchanges continue to perform well also. That's the TMX group. We've held this for about 18 months and just continues to work its way higher. And in the decline, we added CME Group, which is another one of the major exchange groups, because it appears option volume continues to grow. You may be hearing stories, and it's a major revenue source for the CME Group. So financials continue to be leadership. They get stress tested during a decline, and they're an important group. And go figure, they're a group that benefit in a more inflationary environment. Moving on, industrials. After a sharp decline down to the 200-week moving average, like we did see back in 2022, the group reversed nicely. This is the XLI, which is the Spider ETF for industrials. Very close to making new 52-week highs. Started to relatively outperform early in the year and has been relatively outperforming ever since. So we've talked a lot about the aerospace group. This is the ITA aerospace ETF. Same thing, no let up in relative performance. Howmet, which is, I think, the third biggest position in the firm. We've now had this, I think, from around $40. It's $170 today. Again, making new all-time highs and new relative highs. GE Aerospace, which we added not too long ago. And the European defense stocks, powering along as well. It's not just in the US. Clearly, there's going to be a continuation in spending here. GE Vernova in the industrials group, making turbine fans, continues to dominate. Again, made new all-time highs today, doing exactly what we'd hope it to do. And moving on to the energy is a bit of a mixed bag. And, sometimes within a sector, there are dichotomies. If we look at the US energy index, the IYE, relative strength has been falling for 2 years. Big part of that is things that are levered to oil. This is WTI oil, which clearly technically is not strong. There are all kinds of events going on with the Saudis challenging the supply-demand picture. But on the other side, the gas story is pretty good. ARC Resources, a top 10 position for us. Energy stocks, you have to put up with a little more volatility, but it's doing what it should be doing, higher highs and higher lows. And the same picture with Expand Energy, which is the combination of Southwest Energy and Chesapeake in the US. $27 billion natural gas company. And one of the things we talked about through the correction was, what themes do we know are going to be intact, really, no matter what happens to the economy? And one of them is there's going to be a need for a growing source of electricity. And eventually, we think that nuclear winds up being the dominant force. But in the near term, the stopgap is going to be natural gas and liquefied natural gas globally. And so Cheniere is the other position that we think really makes sense as being a critical part of the global infrastructure for delivery of power. Moving on to materials, the GDX, which is the ETF of senior gold producers, broke out about 7 weeks ago. It has pulled back and is consolidating. That's healthy. Our big position here is Agnico, and it's doing exactly that. It's consolidating. You can see a little fall off in relative strength, which we're watching. We took our exposure down by about 2/3 in the golds, which is a difficult thing to do because we think that the long-term picture is very, very strong. But the net of it is we think that they can consolidate a bit. If we start to see some of these make new highs, maybe we make another run at it. But in the near term, we'll wait to see this continue to develop. Communications were strong coming into the decline, and they've been relatively strong going through the period. They lost almost no relative strength versus the market. Netflix has been our big position. It's continued to perform well, made new absolute and relative highs today. Very pleased about that. So these groups, continue to be pretty good. Now, one question we've had through the course of this year has been the consumer. And as I think most people know, we've had a very low weight here. If you look at the XLY, which is a cap weighted index with a big weight on, companies like Amazon and Tesla. But the relative performance has been quite weak. We are potentially seeing a turn in the relative performance. I think it's too early to say, but we are back above the major moving averages. And I think a zero weight doesn't make sense. We have had Loblaws, which is doing exactly what we would hope it to do. Their shoppers business has been strong. Grocery business does well in a more inflationary environment. They have a habit of taking price. That's great. Dollarama as a more defensive consumer discretionary position. Again, making new highs today on a relative basis is working its way higher. But James put on a position in Darden Restaurants a few weeks ago during this decline. And boy, great day today, up 5%, making a new all-time high. So still a relatively low weight, but we're targeted. Technology, still a question mark around relative strength here, is back above the 200-day, has been unable to make a new high since April of last year. But inside some stronger companies, we did add some CrowdStrike in the pullback. This is cybersecurity. Held up well through the decline, has rallied sharply out of the hole, make new relative strength highs and new absolute price highs. That's exactly what we want to see. And we did put a position back on in Microsoft, which again had strengthening relative strength through the decline and has continued that. So we'll see. Semiconductors, I think, still too early. Maybe we're seeing a turn here. The one thing I would say is, I think about 6 months ago or 7 months ago, we said, look, semiconductors as a group have a tendency, even though it's a great sector, to have these big pullbacks to the 200-week moving average, or a sideways consolidation that lasts upwards of a year. And this has happened multiple times going back to 2016 during this tech bull market. So we do highlight that once again, it did pull back to that 200-week moving average. We bounced above it. We're yet to get through the 50-week moving average, which was a sort of a key level to get through in each of the previous corrections. But we're watching with interest as NVIDIA reports this week. Healthcare, nothing to do here. Relative strength remains horrible. Home builders tells you something about the impact of higher interest rates and mortgage costs. Real estate investment trusts, we've talked about the fact that in general, assets that need to borrow a lot of money have a harder time when bond yields are going higher. So the upshot is, financials, again, our largest weight, you can see we added about a 7% to the financials as they were fire tested through the decline. We added back some weight in industrials, which continues to be a good significant overweight. Our energy weight is significant versus the weight in the market, but we think the natural gas theme, both producers and the infrastructure to support delivery, have a natural tailwind. We've taken down our short-term bond weight, which was really we saw as a source of cash, but it gives us flexibility. Same with our corporate bonds. We've still got about a 5% cash weight because coming into summer, it doesn't really make sense to push on things. Technology's up from close to a zero weight to about 5%. That's a big significant underweight, and we need to see some further better development there. We'll watch to see an opportunity to reweight our precious metals. My guess is that's sometime later in the summer. And then you can see, we're underweight against utilities, healthcare, consumer staples, and so on. I still think this is a market where we have to pick our spots. A couple of encouraging things when we look at the spreads that high yield bond investors or corporate bond investors are demanding to take risk. The spreads are coming down. That means the bond market's getting more comfortable with the economic outlook. Maybe the risk is higher growth with inflation rather than recession. And when we look at volatility, after a significant spike, volatility is coming back into this sort of bull market range, a range where investors are more confident. Let's not say confident, but say more confident. And we got to watch the signals. We got to watch the market internals. We've got to watch the signaling that we get. The net of it is we continue to be in a long-term bull market in US stocks. Even if global stocks are outperforming, doesn't mean that if global stocks do well, US stocks have to do poorly. It may just be that we get some outperformance in global equities, which hasn't happened in a decade. If things change, we'll get more defensive. At the end of the day, you can't control the news flow. You can't control what happens in the real world. Your decisions have to be driven by facts and by data. And we just can continue to reassess investing as an iterative process. So as things change, we'll continue to adjust the sails. With that, we got some questions here. Let's see what we can pull up. From John, Trump's great big bill includes a threat to increase tax on dividends to Canadians. We've been asked by a couple of clients on that. It is something that's in process. It's something that's possible. It will ultimately pass. There's two ways we address that. One is, in our products, we do run separately managed accounts, which, do wind up being impacted. And we have a tax treaty with the US, and the withholding tax comes out, and then we claim them back on our taxes. Or in the pooled accounts that we run, of course, that's a Canadian security, and it doesn't wind up being an issue. But it's something that we'll spend some more time on as this develops, and we'll talk about it as we have more facts. Harry has a question: do we own NVIDIA? And if not, what level would be a buyer? And what do we think about the earnings tomorrow? I think tomorrow the earnings are going to be important. I think that we haven't seen enough improvement in the semiconductor sector as a whole to step in. Group still below the 200-day moving average. NVIDIA is a force. And I think that it'll be important to see how the market reacts to earnings tomorrow. So that may sound like chicken, but we don't tend to buy stocks and sectors that are questionable. And we probably need to see more information develop here. They've obviously had some positive developments. We're seeing a reduction in restriction to sell their products to some global buyers, and that could have quite a positive impact. But we're not ready to step right back in yet. We'll talk about that, I guess, next week. Lawrence, Germany, Spain, Italy, et cetera, are all close to 52-week highs. Is it time to enter? Yeah, we're there. We've been buying global stocks now for 18 months. And as you saw earlier, the monthly charts, if you go back a long time, we're only a few months having broken out of, decade-long bear markets. So I look at this kind of like, buying US stocks in 1983. There's a long way to go. And we think that there's probably many years of outperformance here. So as it plays its way out, we'll continue to add weightings. And, we own companies like Embraer and Santander and others. And then we own 80 companies in our global fund, and we'll continue to bump that weighting higher. Question from Lawrence again, what % gold are we now? Depending on the portfolios, we're about 5%. A little more than that in our macro strategy, but we're not pushing on it right now. We think that there's a lot of optimism in the market and maybe a little bit too much bullishness in the very short run. Probably just needs to correct a little bit. And it may well be that we're wrong on that. But I don't want to push against seasonality here. And we did get very stretched above the 200-week moving average. So we'll let this play out and we'll look at re-entering on any kind of strength. With that, I think I got all the questions. Nope. A couple of others. Oh, would we add to EUFN? Yeah, I would add to EUFN. Again, financials are only a couple of years into a bull market that likely to last a decade. So we're there. Paul is asking, for the past year, REITs have been left for dead, sunk to quite low values. This week, they're up a little. I would be careful of bear market rallies. You get short, sharp rallies in a bear market and then steady dripping declines. If you think that yields on 10 and 30-year bonds are an indication of financing costs for real estate, then prices have to come down or rents have to go up. Now, rents are coming down. So if the cost of financing is going up and rents are coming down, that's not a good combination. And if we think we're in a long period where rates will slowly continue to rise, real estate is an asset that you're going to have a hard time making money in. So we are not buying REITs at this point, and the market is not telling us that we should be.
And sorry, Dave, I would just add on that as well, just for the Minto and the car units, Paul, that you mentioned. Interrent this morning was acquired. They were taken private, so that just brought up the rest of the space. The entire multifamily units were up minimum 5% today.
Yeah. Darren asked another question on home builders. The home building stocks have been down, has been a leading indicator for upcoming recessions in the past. We don't see a recession as being the likely outcome at this point. And again, the news continues to change, but it looks like after considering making significant spending cuts in the US, they sort of seem to be abandoning the idea of balancing the budget by spending cuts and trying to grow their way out, which probably means that bond yields go higher, and that's the negative for home builders at this point. So no, we don't think that our base case is that there's a recession in the cards. And frankly, things like the capital markets banks performing well and the exchanges performing well are things that would belie, the idea we're heading into recession. Deborah asks, who won the tennis game after I popped the question? I did ask Natalie to marry me on a tennis court, one of the most beautiful tennis courts in the world in Como in Italy. And as it turns out, we didn't continue the game after that. We were love all. Anyway, with that, listen, thanks everybody for joining the call today. And if you got questions we didn't answer, please shoot us a message or give us a call. And we'll try and get in some nitty gritty next week. But I'm happy to get a good picture of the overview. And I think things look surprisingly well heading into summer. I don't want to ignore the seasonality, but, we can only take things step by step. So thanks very much for joining, and we'll see you again next week.